Well, let's talk chapter 13. We're kind of continuing from the last couple of chapters that deal with investing. Instead of stocks and bonds, now we'll talk about investing in mutual funds, ETFs, and real estate. I've touched on what some of these are in previous chapters, so we'll dive into them a little bit deeper today. So basically learning goals are we're going to just kind of talk through and go through all these different types of investments, learn more about them. How will this affect you? Having a good financial plan, and especially when you're at the point in your life where you can do investing, having a diversified portfolio just makes a lot of sense. This is a great way to diversify risk, spread your funds into different types of investments just to protect yourself and have different types of earnings, and hopefully you can optimize your performance of your portfolio and your mix of investments. So that's really what this chapter is going to help you figure out by investing in ETFs and real estate and mutual funds. I'll let you look at those on your own. Just some basics though. A mutual fund is a company that basically sells investments, and what they are is a pool of investments. You can buy a mutual fund where it's the stocks in that fund or the investments in that fund are managed by a professional investment manager, and they all have a common goal. If it's size, if it's the type of industry they're invested in, their income generating stocks, growth stocks, whatever that might be. But that's what mutual funds are. An ETF is an investment company whose shares trade on the stock exchange like a stock. I mean, they exactly work just like a stock. They're created by investment companies, and so what these investment companies do is they buy a whole bunch of the actual stocks that are traded on an exchange, like the Dow Jones or the S&P 500, and then they take those, hold on to them, and they sell shares of an ETF, which trades exactly like a stock, and it goes up and down with the market, can be bought and sold throughout the day, and just basically it changes in value basically in relation to the change in value of the exchange that it's tied to. It's just a really good way to get the market return without having to buy all the stocks on the market. That's probably the best way to describe it. And they're very easy to buy. They're easy to get into and out of. They have no fees. Just that the only fee is just what you spend to buy them, and commissions to buy a stock is very, very low. So mutual funds, there's actually about 8,000 mutual funds with $15.9 trillion invested in mutual funds, and so there's more mutual funds than actual stocks on exchanges that you can buy and sell, believe it or not, which is kind of a strange concept, but it's very true. Professional money managers select the stocks within the portfolios, and the dividends, interest, and capital gains earned by the mutual funds flow through to the investors. The mutual fund company does not pay tax on any of the investment returnings. Instead, the people who own shares of the mutual fund pay that tax. So to invest in a mutual fund, you get diversification. It's easier to diversify by being in a mutual fund than it is to diversify on your own. The desire, of course, is that a professional money manager might get you a better return than you could on your own. They're very convenient, but the investor has zero control over buying or selling of the securities. Now, you can buy and sell mutual funds, very easily. It's very easy to get in and out of them. And they probably are so popular also because of 401ks, which is a retirement plan. And when you get into a 401k, which we'll spend more time talking about in the future, you are buying mutual funds. Just some examples of mutual fund returns based here on fund type. You can see there's all kinds of types. There's more types than I've mentioned, but you can buy types based on stocks in a certain industry or segment of the economy also, and you can see what those returns are. Mutual funds. Each mutual fund is a separate organization owned by shareholders but controlled by fund managers. Management companies runs their daily operations, and there's a lot of bookkeeping behind the scenes that mutual fund companies have to keep track of. I've worked in finance and investments, and it takes a fleet of really good people just to make sure that everything's being accounted for correctly, that everybody's portfolio balances are done correctly, and so on. So there is a lot of work that has to go into managing a mutual fund, more than you might realize, and that's part of why they charge some fees, because they got to pay for those costs. costs. You have an investment advisor who oversees a portfolio, makes decisions. A custodian safeguards the assets. They're held with a independent custodian. They actually have custody electronically, essentially, of all the stocks and bond certificates, but somebody else has those. And Fidelity is one of the really largest mutual fund companies. There's Northwestern Mutual Life, Fidelity, there's all kinds out there, the Hartford, there's dozens and dozens of mutual fund companies out there. And what they do is they create a portfolio of mutual funds that they run, and they might have a couple hundred different mutual funds within their portfolio to meet the needs of different types of investors. They are what they call open-ended investment companies because anybody can get in. They'll continuously accept new money coming in. They'll just use that new money to buy more investments, and you buy into by buying shares from the company. Then when you sell your shares back to the company when you want to get out. So new shares are issued just simply as money comes in. Every day at the end of the day, they have what they call a net asset value, and what that means is they just do a market valuation every day of the portfolio, and then electronically you can log onto your account and see exactly what your portfolio is worth at the end of the day. So that has to be done at the end of the day. So having worked for a company that did these, we had a fleet of people that they came in later in the morning and stayed later in the evening because their job was to receive the file from the mutual fund companies themselves. That had to be an electronic file. We had to import that and then update every individual investor's portfolio so everybody knew at the end of the day what their value was, so they could log in nightly and see their value, or the next morning. But they had to be done they wanted it done by 7 p.m. every night. We had to wait till the market closed, let the fund company process it, they send it to us, and we update individual customer files. So it's just a lot that goes on to keep these going. A closed-ended investment company only sells a fixed amount of shares. And once they sell enough, they're done. They will not accept new monies. That's the only difference between the two. So net asset value, I kind of already mentioned that. Just the market value of all securities held in a portfolio divided by the number of shares outstanding. And that value goes up and down every day. Excuse me, the value is determined at the end of the day. And that's basically that value at the end of one day is the quoted price to sell it for the next day, because they only update the value at the end of the market closing. So if you want to buy on the 10th, you buy based on the value at the end of the closing day on the 9th, for example. ETFs, I've already mentioned a few things about them. They're typically structured as some kind of an index, and they're getting more and more sophisticated. They're getting to be more and more of these. One of the most popular ones is what they call the SPDR, SPDR. It's the S&P 500 ETF. It tracks the S&P 500. So by buying a SPDR, you essentially get the same return that the entire S&P 500 gets, up or down. But you can buy them based on the SPDR Dow Jones Industrial. You can buy them on what they call power shares, Triple Q Trust, Series 1, NASDAQ 100. There's all kinds. So whatever you're buying, it's just based on a portfolio of stocks behind that, and you get exactly the same tracking that those stocks get. And what's different about these is they act just like a stock. You're buying and selling them between investors on a stock market. So they trade just like a stock. The value is updated continuously throughout the day. And so so that's what's kind of nice about them. And there's really no fee. Mutual funds charge fees either to get in the mutual fund or get out of it. Whereas ETFs, because they trade like a stock, all that you have to do is log on to your brokerage account and make a trade. And a lot of brokerage firms will give you, $5 trades, $6 trades. It kind of depends how much money you have in your account and what kind of account you have set up. So let's talk about fees. I mentioned that mutual funds have fees. Low load funds, the commissions are 2 to 3%. And that's the mutual fund just covering their expenses and trying to make a profit. They're not making profits on the investment portfolio because that flows through to the investors. So they have to charge a commission to cover their cost. And that's basically the bookkeeping, behind the scenes, the front office cost, back office cost, sales commissions to the people who sell them, and the portfolio advisor just paying for that person or that group of people also. Um, the SEC puts regulations on mutual funds. Clearly part of their mission is to protect investors in terms of disclosures and regulation, how much can be charged for commissions and whatnot. So the maximum fee is 8.5%. So clearly it's a very competitive market, and so you can easily find mutual funds that will pay less, charge you less than 8.5%. That's not hard to find. They have no-load funds that don't charge a front-end transaction fee, but then they have also fees to get out. And if you get into a no-load fund, you probably are paying something at the end to get out of it. And a 12B1 fee is a fee that a mutual fund company can charge to basically offset their promotion and selling expenses, which kind of covers their commissions for anybody who sells their product to customers. So management fees, again, is the cost to hire a professional manager and run the investments. The fees usually unrelated to performance of the funds, good or bad. The manager of the portfolio and the people who are needed to run the portfolio, they get paid in a good year or a bad year. But the thing about fees is they reduce your return. So the downside of a mutual fund is that fee is taken out, and that just reduces your return. The goal is to what most people are assuming, and generally it's the rule, is that if you have a professional money manager running your portfolio, they'd get a higher return than you would on your own anyway. So types of mutual funds, I've mentioned there's a bazillion, and there's just some examples right there. The one that's kind of interesting too, I think, is socially responsible. So they may only buy companies that they believe promote certain values. Whatever those values are. Like some will maybe not invest in tobacco or not invest in alcohol or whatever that is, and they'll let you know. I mean, there's always brochures and and pamphlets and things you can look at that describe the funds, what the goal of the fund is, what kind of investments are already in the fund. That you can easily find that information out to make a decision. What's really nice about mutual funds too is the ability to buy a bond fund, and I will just tell you that as an individual investor, there's really no need for an individual to buy a bond. Instead, if you want to diversify your portfolio to own some bonds, let a mutual fund company buy the bonds and manage those for you. Buying bonds and managing a portfolio of bonds is extremely different than stocks. It's much more complex and complicated, and having come from a company that did that, I can just tell you it's not easy. So from an individual perspective, it's not a bad idea to buy and own some bond mutual funds. They will diversify your portfolio. They're a lower risk investment, which we've shown in previous chapters, and so it's not a bad idea to own them. Just what percent of your portfolio will probably change based on your age and your investment needs, your investment goals. But just go ahead, and if you want to get into mutual funds or bonds, just do that through a bond mutual fund. And you can see there's all different types of bonds that are out there. We've already talked about some of these in previous chapters anyway. And this service is offered, and I've mentioned a few of these before too. Depending on the investment you make in a mutual fund, quite often what they will do is just take any investment returns that you earn, dividends or interest, and just buy more shares for you. That's generally what they do unless you tell them differently. And the automatic investment plans, it's basically just saying, I'm going to tell my mutual fund company, I'm going to authorize you to take $100 out of my paycheck every month and buy more shares of a mutual fund. You can definitely set up something like that too. And just doing something like that kind of makes it a no-brainer, right? It's just kind of that, it just becomes habit. It just happens automatically without you having to be intentional about it. So if you just know that's the way that would work best for you, maybe just put a few $100s down to buy a mutual fund initially, but then you can just say every month take X dollars from my paycheck and just invest that. Conversion allows you to switch from one mutual fund family to another within the same company. For example, we're using Fidelity here, which is one of the largest in the nation. Basically saying most of these companies will let you transfer money from one fund to another within their family of funds without withdrawal fees, which for tax purposes is for tax purposes, that may generate a gain on a sale potentially, just because it's technically, the IRS says that's a sale and a buy. Now the good news is, though, they won't charge any fees. The mutual fund company won't charge you fees, but the IRS will look at that for sure and go, oh, there will be um, um, a gain potentially between the two. So you have to be careful about that. And of course, they all offer retirement plans. And if you buy a mutual fund through a retirement plan, you don't pay tax until you make a withdrawal. Okay, so they kind of handle the administration for you, and that's really what 401k. That's really where, if you get into a 401k where you work, the money you set aside, you choose what mutual funds it goes into, but because that's within the umbrella of a 401k, you do not pay tax until you retire and make withdrawals. So just selecting your mutual funds, that's the challenging part. My advice to everybody is ask somebody. Don't just do it on your own unless you feel like you've done the research and feel confident in that. But if you have any hesitation whatsoever, talk to people you trust and you know. If that's parents, co-workers, anybody in your family who you believe knows a little bit about finance. My recommendation is to talk to a professional, somebody who is a professional money manager whose job is to help people meet their financial goals by investing and setting up a budget and stuff like that, because they've been there, done that. They can give you some good advice. They know what works, and basically it's just a matter of choosing a few mutual funds that will give you a good return and not expose you to too much risk. That's really the goal here. And so just consider what your objectives are, consider what you're setting money aside for, and that will all help you. So when you work for a company that offers a 401k, that company will bring in an advisor or let you know who that person is so you can set up a meeting with them. I would strongly encourage you to meet with whoever the advisor is that they bring in. And they'll probably bring in more than one, and they usually make them available for a day or two, at least once per year within the office that you work at, but they're always available for you to go and visit with at that individual's office, or call them or email them or whatever. And that's just a part of their services. Your company that is giving you a 401k, there's a fee for that they're paying for, and so it's not going to cost you anything out of your pocket to meet with those types of people. So I would just say, if it's a 401k that you're buying mutual funds through, meet with the representative of the 401 or the mutual fund company, and just ask them for advice. That's what they're there for. And if you are doing something on your own, if you're doing something on your own investing wise, I would suggest that you ask somebody to, just kind of get some advice from somebody that you trust. And again, I know several people who have ties to USF who would love to visit with you regarding investing, and I would gladly give you a name and a number and an email address to get a hold of them. Now, choosing between a mutual fund and an ETF, it depends on what you're trying to do. Through a retirement, a 401k account, most likely you're only going to have mutual funds to choose from. If you are just investing your own money on your own, trying to grow it, not necessarily within a retirement account, my suggestion would be to buy an ETF because it's just cheaper and easier. All you have to do is create an online trading account through TD Ameritrade, Scottrade. There's a bazillion of those, and they're really cheap to buy. You just put a few $100s into the account, and you can set up something where they can take money from you from your bank account automatically once a month and put that into their account, and then you can tell them once there's money, buy X, go and buy this. You can just set that stuff up automatically if you want. But an ETF is a really good way to get into the stock market. With there's still risk, but it's just really easy. You don't have to worry about, okay, what companies am I going to buy? Why am I going to buy them? I'm okay getting the return on the market, and I've shown you in previous chapters that the return on the market generally is really good. You can get some really good returns. You just have to know there's some good years and some bad years. And if you just think long term, I'm going to ride out the bad years because I know there's going to be more good years, you'll be okay. And then ETFs are traded less than mutual funds are. They're a little bit easier to handle from a tax perspective. They have lower costs to get into. And it's that down here. Generally, if you are setting money aside that you're thinking more long term with, an ETF would be a great way to go. Also, as you do homework on investments, it's important that you think through fund performance. Mutual fund companies, they'll give you a prospectus and it will explain the past performance of their mutual fund, but just know that that is never a guarantee of future returns. But it's always good to know how they've done in the past, because that helps predict the future, but it's no guarantee of the future either. And then in your chapter, go ahead and take a look at Exhibit 13.9. It will show you some performances and some returns and ratios for mutual funds. And I should just mention to you, the homework for this chapter is going to deal more with mutual funds than anything else. So that Exhibit 13.9 will be a good one to kind of take a look at. Part of the homework will be looking at some mutual fund numbers and making decisions, kind of telling Cengage, okay, the price of that mutual fund is X, and so on. Just so you have a table of numbers in Cengage you'll take a look at and plug in some numbers and do some small calculations into Cengage for the homework. So it's mostly about mutual funds. Performance of ETFs, again, the performance of the ETF is directly tied to the particular index that the ETF is based on. Okay, a little bit about real estate. Real estate has less volatility than stocks. It's a good way to have diversification of your portfolio. Real estate does not move in the same direction as stocks do, so that's probably good if you're trying to diversify. However, it can be very expensive. So, for cash flow and tax impact, depreciation is a non-cash expense deductible for tax purposes. So if you own real estate that you are hoping to get some kind of return out of, you have a tax break of depreciation, which is good. It's considered to be a passive investment, and passive losses are limited to passive income, which could be good or bad. And appreciation value is deferred until realized or sold. So the nice thing about real estate, typically real estate goes up in value over time. That's generally what you're looking for. So just keeping that in mind, I'm going to buy real estate with the goal of it going up in value. Excuse me. And I don't have to pay any tax until I sell it. So I realize the cash, then I pay the tax. Quite often people borrow money to buy real estate because it's very expensive, and so that's using leverage when you're using somebody else's money to help grow your own investments. But you have to know the market that you're investing in. That's really important. Real estate's very local. And so you only want to invest in markets that are robust and growing, where there's demand. You would not want to invest probably too much in a real estate market where people are leaving, industries are closing down. That would not be a good thing. You want to invest in a growing market. If you decide to get into real estate, commercial property or residential property would be your two choices. Commercial property, you just drive up and down 41st Street or Minnesota Avenue in Sioux Falls, and that's all commercial property, right? It's offices, industrial warehouses, retail, hotels. That's all commercial. Typically, those businesses are signing a very long-term lease with whoever owns the actual property if they don't own it, and so rent may include a portion of revenue that so you're going to get a lot of rent revenues out of that. That's kind of the whole goal of owning commercial property. Residential property is where people live. Homes, apartments, condos, small duplexes, fourplexes, duplexes, things like that. There's lots of ways to get into real estate. I know some people who own a fourplex. They rent it all out. It can be a lot of work. It's not for everybody because of that. Now, however, there's a really good way to invest in real estate that's really, really easy, and that's what they call a REIT, R-E-I-T, Real Estate Investment Trust. And these are companies that basically own a whole bunch of real estate, and they manage properties. So a REIT, for example, could own a whole bunch of apartments and commercial properties. And then what that REIT does is they manage those, they collect the rents, and then if you buy into a REIT, you get a portion of the profits. And so we're actually required to distribute a very high portion of those profits. So buying a REIT is just like buying a stock. They trade exactly on the stock market. It's a great way to get into real estate and have a real estate investment that's extremely liquid and easy to sell. They are required by tax law to pay out, I believe it's about 80% of their earnings have to be paid out as dividends. So they're very high dividend stocks, and they don't fluctuate in value a whole lot. They don't jump up and down as much as other stocks do. So if you are interested in owning real estate, a REIT would be a great way to do it. So REITs can manage properties, REITs can manage mortgages, or some combination of the two. So just FYI, but they both are tied to real estate. So just a great way to invest in real estate without having to actually own real estate. And the downside about owning real estate, it's not a very liquid investment. It's not something that you can easily sell. If you have any questions about the chapter, just let me know, but hopefully you'll find this one interesting.